welcome to The Explainer. Today, we're taking some incredibly deep financial research and transforming it into clear, structured insights. If you're the kind of person who likes cutting through all the daily market noise to find those truly high-quality, compounding businesses, well, you are definitely in the right place. All right, let's just dive right into it.
Food service contracting. I mean, honestly, it sounds like a total low-margin snooze fest, right? Just serving meals in corporate cafeterias. But here is the crazy part. Top analysts are practically jumping out of their seats over one specific company in this space right now. We are talking about a business that has gone through this brutal 18-month valuation derating, dragging its price-to-earnings ratio all the way down from a peak of 35x to a forward multiple of just 22x.
Now, what's wild here is that this massive valuation drop actually represents a window that historically comes right before some serious market outperformance. According to Bernstein Research, seeing this specific company at these valuation levels is a historically rare opportunity. It's like finding a glitch in the matrix, mirroring these very brief windows we saw back in 2016, 2018, 2022, and 2023. So it really begs the question, what exactly is the market missing here?
So, here is our roadmap for today's explainer. We're going to cover 1. A rare valuation opportunity, 2. Defining the moat, 3. The outsourcing expansion engine, 4. The high-quality financial flywheel, 5. Structural risks and headwinds, and finally, 6. The final verdict.
Okay, part 1. A rare valuation opportunity. The global giant hiding in plain sight.
To really get why this matters, you've got to understand the sheer, frankly staggering scale of Compass Group. Founded in 1941, this is the world's largest contract food service company. And we're not just talking about flipping burgers in a single corporate cafeteria. They operate across more than 30 countries with a massive workforce of 580,000 people. They manage over 180 distinct subsectors. That means they cater absolutely everything, from high-end corporate dining rooms and hospital dialysis centers, all the way to massive sports stadiums and literally remote offshore oil rigs.
Moving on to part 2, defining the moat, separating the best from the rest.
Now, you might be wondering, how on earth does a physical, labor-intensive food service company create a durable, competitive moat? It's just food, right? Well, the numbers tell a completely different story. A return on equity this high, 27.1% over the last 12 months, combined with a stellar 72.4% gross margin, proves this is a high-quality compounder. This is not just some commodity caterer fighting for scraps. This is a highly optimized, capital-efficient machine. And this right here paints the picture perfectly. Look at Compass next to its biggest global rivals, Sodexo and Aramark. It's literally not even a close fight. Compass controls roughly 25% of the global market. They are 3 to 4 times larger by market cap than the number 2 and 3 players. Because of that absolute dominance, they have this unmatched procurement leverage. Basically, they buy food and supplies at way better prices than anyone else, which translates directly into that industry-leading 7.4% operating margin.
All right, part 3, the outsourcing expansion engine, a massive macro tailwind.
Listen, having a big slice of a pie is great, but if the pie is stagnant, it's hard to get excited about long-term growth. Luckily for Compass, their pie is getting absolutely massive. We are witnessing this huge structural megatrend where organizations all over the world are suddenly realizing, hey, we probably shouldn't be running our own kitchens. This outsourcing trend is projected to balloon their total addressable market from roughly $360 billion today to an estimated $600 billion by 2035. That's a 67% expansion over the next 12 years.
And the real beauty of this expanding market is how Compass goes after it. They aren't trapped in some brutal margin-crushing price war with Sodexo or Aramark. Actually, a staggering 85% of their new business wins come from converting clients who are outsourcing for the very first time, or by just displacing tiny, inefficient local operators. Only 15% of it comes from stealing share from their large global peers. They're just riding this massive wave of organic market expansion. And they're capturing this growth everywhere. Business and industry is their fastest grower, making up about 30% of revenue. But they are also deeply entrenched in healthcare, which is just riding a massive aging demographic tailwind. They're expanding aggressively into defense, serving military bases, and get this, they are even locking down exclusive catering partnerships for massive data centers. This kind of diversification is incredible because it severely cushions the company if any single sector takes an economic hit.
Part 4, the high-quality financial flywheel, strategic levers for margin expansion.
So as the market expands organically, management isn't just chilling on the sidelines. They've built this incredibly precise algorithm to crank up profitability year after year. It's a three-step flywheel. Step 1 is maximizing their group purchasing organizations, or GPOs, using their massive scale to crush food costs. Step 2 is overhead leverage, just spreading fixed costs over a larger and larger revenue base. And Step 3 is strategic M&A, bolting on companies like Vermat and Procare to extract rapid synergies. Put those together, and Compass targets a consistent 10 to 20 basis points of margin expansion every single year.
On top of all that, they're heavily digitizing what is fundamentally a physical business. Compass is pouring a whopping $300 million annually into proprietary tech like their Centric OS platform. By rolling out AI for demand forecasting, labor scheduling, and waste reduction, they secure this operational edge that the smaller, local guys literally cannot afford to replicate.
Which brings us to Part 5, Structural Risks and Headwinds, the yes-but factor.
Okay, let's keep it objective here. No company is invincible. We have to look at the structural risks currently testing them, the yes-but factors keeping the valuation somewhat suppressed. The biggest, most obvious long-term threat is permanent hybrid work. If corporate offices stay half-empty, the business and industry segment could face real volume declines. But check out their mitigation strategy. They went straight for the absolute top tier. They locked down exclusive partnerships with 5 of the 6 Magnificent 7 tech giants that outsource. And incredibly, revenues from their top 10 tech clients are actually up 36% over the last 3 years.
Another immediate risk making investors a bit cautious is the balance sheet. They recently dropped $2.3 billion on acquisitions, which temporarily bumped their net debt to EBITDA ratio up to 1.7x. That's above management's comfort zone of 1 to 1.5x, limiting their short-term flexibility. But, and this is where the sheer safety of the business model shines through, Compass generates an absolute torrent of cash. We are talking $2.2 to $2.4 billion in annual free cash flow. That allows them to just naturally, comfortably deleverage over the next 12 to 18 months without breaking a sweat.
We also got to keep it real about a few operational bumps in the road. Their North American healthcare segment has been sluggish, dipping to 4.1% growth, and management openly admits they need to fix that. Also, Q2 net new business slightly missed targets because of weather delays pushing back new site openings. Plus, persistent minimum wage inflation in both the UK and the US is constantly threatening to squeeze labor costs, forcing Compass to lean heavily on their dynamic pricing contracts just to pass those costs on.
Finally, Part 6, the final verdict, timing the market opportunity.
So, let's pull all this together. The massive moat, the growing market, the flywheel, the risks. The operational momentum here is undeniably building. They delivered record execution in the first half of 2026, successfully expanding margins. That actually led management to raise their full-year guidance to above 11% operating profit growth. Now, all eyes are on November 2026, which is setting the stage for major capital allocation announcements and potentially even new stock buybacks once those debt levels normalize.
Right now, Wall Street consensus gives us an average price target around $38.28. So, we're talking about a very robust 17.7% implied upside, signaling a solid recovery rally as the company finally emerges from its 18-month valuation derating phase.
So I'm going to leave you with this to chew on. Do temporary headwinds, like a slight bump in debt from strategic acquisitions and some sluggish healthcare growth, really outweigh a dominant global leader riding a $600 billion secular outsourcing tailwind? Is this temporary friction a reason to stay away, or is it exactly the reason this historical valuation window even exists in the first place? Thanks for hanging out for this deep dive. Let us know your thoughts, and we'll catch you in the next explainer.